Ladies and gentlemen, my name is Jess Vergale, and you're listening to Working Capital, the real estate podcast. A special guest today. We just chatted about this. If you don't know him by now, I don't know if you want to know him, and that is Dr. Peter Linneman. He's the author of the Linneman Letter, the former professor of real estate and finance and public policy at the Wharton School of Business, and he was previously listed as one of the top 25 most influential people in commercial real estate. Peter, how you doing?
I'm doing great. I just got back from Egypt, so my background is a long-lasting quality piece of real estate, the Luxor Temple in Luxor. So good reminder that great real estate lasts like 4,000 or 5,000 years.
There's a book I'm reading right now, and it's on the evolution of skyscrapers, and it goes back to the pyramids. It goes back to the renderings in the Bible of places that maybe existed, architecturally look sound, but that is it's fantastic to see how we've come from there to where we're at today, and the drive for humans to build up hasn't seemed to wane in any way.
When you see this stuff from 3,000, 4,000 or 5,000 years ago, you go, okay, they got it.
Yeah. Well, thanks so much for coming on. I think this is a real treat for listeners. For anybody watching the video, I'm holding up my real estate and finance and investment book written by the Dr. Peter Linneman. And I mean, if you're in the real estate industry in any capacity, you would have come across this book. I think this, for me, it was second year of the MBA in Toronto, and it was just chock full of amazing things. This thing, how long has it been now? When was this first published?
Oh, gee, probably 16 years ago or 17 years ago was the first edition. It's come to be referred to as the Blue Bible. I don't know if that's a good description. It came about very oddly in that I was teaching my real estate finance investment course for a number of years, and I never had a book that I could find that I really liked. So I was teaching my own stuff, but I assigned a book to students because they needed something. So we finally recorded my lectures, and after a lot of work and a lot of now additions, that's what came out of it.
Yeah, well, it's great. It's funny. You go through a time period where you're like, okay, I got to get rid of these books. Usually the textbooks are the first to go, but I've hung on to this one for a long time just because I've actually kind of gone back to it. And now that we're at the stage in the career where we're hiring younger individuals, this is something where, they're probably reading in school, but it's definitely something that they can use as a resource.
Well, and one of the other things nice is it's a nice color. So while it's on your bookshelf, it looks good.
Yeah. It's not that old school, just taupes. Well, you know what? There was so we chatted a little bit earlier. You were on a podcast that I recommend, Hunter Thompson Cash Flow Connections podcast. And there was something that I was driving in the car listening to this podcast, and I had to write down because I was just like, you know what, it was something you said, and it was just an insight, and maybe we could use it kind of as a springboard for this conversation, because that conversation did talk a lot about the economics of real estate and where we find ourselves today. And what you said was demand, as loosely described as real GDP growth, is up 3%, and goods, as loosely described by industrial output, are down by 1%, and services, as loosely proxied by employment, is 1% short. Demand is up, supply is down, prices go up. Can you break that down for us? What we're talking about here?
Yeah, I mean, I think you broke it down really well. I think there is very real inflation. The very real inflation started to occur. Let's just do a quick review. 2020, 2 years ago, things are shut down. Like a third of the economy is shut, not just slow, shut. And then another third is really slow, but not shut. And then another third is working. Well, when you shut things, there are ramifications of that. So for example, 2 years ago, the price of oil is like $5, $10 a barrel. So what do you do with the tar sands? Shut them down. What do you do with the fracking? Shut them down, because they aren't even close to break even. I'm just taking those as dramatic examples. Then what happens is, fortunately, the economy, I'm talking about the US, but I think the Canadian, pretty similar, by very late 20 and then through 21, starts growing, and it grew faster in its comeback than supply came back. Now, that's not surprising when you think about it, because things are really awful. Do you expect supply to lead demand? No. Common sense says I wait to see if things are really there before I expand and bring on capacity. So what you've got is real GDP, kind of a crude metric of US demand, up 3.2% versus pre-COVID, not annually, the 2 years since COVID began. And goods output is down 1%, as you say, and employment is down 1%. And as you said, you don't have to be a genius to figure out supply down 1% from where it was in 2019, demand up 3.5%, prices are up. Now you could have a long discussion of which prices and how much, some more than others. It's that simple. When will price inflation moderate? Pretty simple. When supply catches up. Now, there's this notion that we have to cool demand. And I ask people, would we be better off if we had no inflation right now and GDP was also down 1% over those 2 years? By the way, if real GDP was down 1% and industrial output was down 1% and employment was down 1%, you think we'd have much inflation right now? No. Would we be better off? Absolutely not. We'd be 4.5% worse off. So you go, okay, it's a good thing. In fact, not only is it a good thing, it's a staggeringly amazing thing that after the last 2 years, where we shut down huge swaths of the economy, political division, COVID killing millions of people, many more getting sick, absenteeism at work, social unrest, a war now. I mean, name all the stuff that's happened, and we're 3.5% or 3.2% larger as an economy than before. That's amazing. But left to its own devices, it would have been up about 5.5%. So demand's not overheated. If real GDP was up 10%, then I'd say that's overheated. We can't do that. But we can do 5 to 5.5% over a 2-year period. We've only done 3.2%, underheated. We still need demand to keep driving forward. We don't want to slow down demand. We want to encourage supply. So if we were going to do policies, the kind of policies we need are, and I'm just giving as an example, I'm not proposing them. You drill an oil well this year, or you start pumping from a well that isn't pumping, you could write it off in a year. Right, you think you get more exploration with that as an incentive. Or if you hire somebody, you net expand your employment, you get a $4,000 tax credit. Or if you come back to work after not having worked for six months, all of these I'm just making up as examples, you get a $2,000 tax credit as an individual. You think we'd bring back more labor? Do you think we'd bring back more capacity? And as we did, what would happen to prices? They'd go down. So I don't think this is about demand. It is in some tautological sense. It's about supply has made an amazing recovery from a shutdown, but still lags. And I don't know how monetary policy gets us to bring back capacity faster. That's a real activity, so to speak. So that's how I see it. And it has some ramifications for real estate. Your construction costs are really going up, right? I mean, that's not an imagination. But on the other hand, so are your rents, so are your property values. And you have to take the whole menu. It's like when you played cards and you got 3 aces and a 2 and a 3. Hey, that's a pretty good hand. You got 3 aces. Be happy. Don't gripe about, gee, I should have 4 aces, right? All things considered, pretty good here.
So when it comes to real estate, from the point of view of a couple of variables, there's inflation in the general economy that people just seem to be continuing to worry about time and time again. This time it's different, as Howard Marks titles each one of his chapters in his latest book. But what I'm curious about is, from a real estate perspective, we have the valuation of the real estate asset, and we have those prices in our markets and a lot of other major markets in North America going up. And the concern is that these cap rates get compressed and compressed. How much lower can these cap rates get compressed? What I'm curious about, is it going to be the valuation that gets out of control, or will it be the affordability from a rent perspective that you see as the governor, so to speak, in that dynamic?
Ultimately, it's the fundamentals, and that would go to more to the rent side. Price is just an outcome, right? Price is the value of a property is the combination of the supply and demand for space, right? Namely, income and rent and occupancy, and the supply and demand for money to buy income streams, right? And they don't necessarily always align. We're in a period where the supply and demand for space, rent and occupancy, is in quite good shape, unless you're in senior housing, unless you're in hospitality, still lagging, unless you're in bad retail, unless you're in office where you don't know if people are coming back to the office. But if you're in apartments and warehouse and good retail, quite good, rent and occupancy side. Now on the capital side, what's happened is QE1, QE2, QE3 after the financial crisis put unprecedented amounts of money into the system. And you saw it coming out in 2014, 15, 16, 17, 18, 19. And that money searching for a home pushed down cap rates. And everybody kept saying, oh, cap rates are going to go up. Cap rates. I kept saying, no, the weight of money is going to push it down. Now we've even put in a lot more money in addition into the system. What do you think happens when that money comes out? When that money comes out, it's got to find a home. So for example, we have record personal cash holdings. We have record corporate cash holdings. We have record dry private equity capital. We have record dry uncommitted money at sovereign wealth and pensions vis-a-vis real estate. And we have record unused bank reserves. What do you think happens when they may still be at record levels, but a little lower record levels? And the answer is that money's going to find a home, and it's going to find it buying cash streams. Some of that is on the stock market, some of it is real estate, some of it is gold. And I think cap rates go down. Now, do they go down every day? No. And people say, well, how much lower can they go? Things can always go 2% lower. It's one of the things that, remember when you learned about penny stocks and somebody said, well, how can you lose? They only cost a penny. And you go, well, they could go to a half a penny, right? They could go to a quarter of a penny. So how can the cap rate go lower than 3.7? Well, it can go to 3.6. It can go to 3.5. And the reason is the weight of money. So what do I mean by the weight of money? The example I use, the thought experiment. We've done a lot of statistical work on this that I won't go into. It's in Linneman letter. It's in other stuff we've written. But here's the thought experiment. It's very simple. Suppose I told you a year from now, $4 trillion, I don't care if it's Canadian or US, $4 trillion in addition to the amount already invested is trying to invest in apartment buildings, okay? What do you think will happen to cap rates? They'll go down. By the way, you didn't ask, what's the economy like? You didn't ask, what are interest rates? You didn't say, is the yield curve inverted? You simply said, well, that kind of money, it's got to find it. It's going to bid up the values, bid down cap rates. Now flip that thought experiment. Suppose I told you that a year from now, $1 trillion is exiting apartment buildings. By the way, you could apply this to any property category. And you'd say, wow, that's going to be a problem. $1 trillion trying to get out is going to crush values. And you go, you didn't know what interest rates were when you made that insight. You didn't know what the economy was. The point is the weight of money. And we have put unprecedented amounts of money in, and it hasn't really come out yet to speak of. And it will. And it
So,
will be asset price inflation, not goods and services.
so a question on that. We've had economists on the show before of maybe on the one side closer to the Austrian school, the other side, the modern monetary theory, MMT. And for listeners, I would just look up both of those to learn a little bit more. But this idea that when the great financial crisis was happening, there was a number of economists that were saying, you're putting money into the economy, like your example, 4 trillion, 5 trillion, that is going to cause inflation no matter what. However, what was happening was it was sitting on balance sheets of banks. It wasn't getting into the economy. And I always think about Milton Friedman's, I think it was his Nobel, part of it was this velocity of money. It can't just go into the economy. It actually has to move to create some form of inflation.
Correct.
So in this example, could you talk a little bit about when you say the 4 trillion in the market, does that mean on banks' balance sheets? Does that mean it's circulating? Are those necessary conditions?
Yeah, at this moment, the same thing happened that happened after QE1, QE2, QE3, which is the amount of money going into the banks skyrocketed, and the velocity with which they used it plummeted. So that in the beginning, there was no notable effect on the net economy. It just kept the ship steady, if you will. And then the money started coming out slowly. When I say slowly, just a little more rapidly than it did before. And remember, the modern banking system is not set up to lend you money to buy a Milky Way. It's set up to have an investment firm buy the company that makes Milky Way, right? It's set up for that. And that's why as 2014 through 19 occurred, the money chased assets rather than goods and services, right?
Yeah.
And so I think that's what's going to happen again. By and large, the money went into the system to keep it afloat in the way you described, to make sure there was liquidity. I think it did it well. And now what will happen over the next few years is it will come out. Will all of it come out? No, the velocity dropped, but as some of it starts coming in, if I put a ton in beyond whatever you had, even if only 1,000 pounds of it come out, it's a lot of weight, right? A lot of weight. If I put 100 tons in, even if only 1,000 pounds come out, it's still a lot of weight. It's not much compared to what went in, to your point about velocity, but it's more than would have otherwise been there. And I think it will chase primarily assets. Now, I would include single family homes in that as an asset, right? It's a real asset.
Now, when it comes to the economy itself, well, you know what, let's back up for a second. I did have somebody from my office. They said, you know, you have to ask, I told them I was having you on. And he said, ask him about the relationship between cap rates and interest rates, because we talk a lot about that spread in our industry quite a bit. Basically, is it a significant piece of what you guys look at over the long term? How is it tracked? You know, and you mentioned earlier the Linneman letter. We'll put a link up to that as well. But I'm just curious, in the work that you do, how important that relationship is, if at all.
If there's a relationship, it would be important. However, having studied it, we can't find a relationship. Other than that, so I'll give you, for example, I think it's I can't remember if it's 40 years or 45 years. Basically, the 10-year Treasury yield has fallen by 600 basis points, and the cap rate fell by 300. That's hardly 1-to-1. Then if you look at the micro history of that movement, it's all over the place. That is to say, the spread, movements in the spread basically swamp the general downward decline, right? I mean, the spreads are all over the place over history. Then go one step further, and I'll give another example. We looked at it very sophisticated statistically. Can't find it. Can't find the correlation. Now, by the way, if you said the 10-year Treasury went from 2.3% today to 14% tomorrow, that would probably have an impact, but that's not likely to happen. If you said it went from 2.3 to 2.9 or 3.2 or back down to 1.6, by the way, we saw it go from 1.6 to 2.3. What happened to cap rates? They went down, if anything. Why? Because of the weight of money. Not because the interest rates went up. In other words, it's not interest rates going up causing cap rates to go down. It's there's no relationship. I'll give you the other that captures it. If you look at 2007, cap rates were essentially identical to 2019. Okay, 2007, 2019. In 2007, the long and the short rate were above 5%. And in 2019, the short rate, I'm doing from memory, was 2.5 or 2.6, and the long rate was 3.2. How can that be if it's interest rates that are causing that? That interest rates are 200 basis points higher and you still have the same cap rate? That should tell you something, right? And in fact, we've seen periods where there's a flight to quality. When there's a flight to quality, interest rates go down and cap rates go up. Well, so much for the lockstep relationship. It just doesn't exist, at least in the relevant parameters, at least that we can find or that I have seen. One other thing I'd add about interest rates that I kind of tell friends and clients to calm them down. Let's just assume that a year from now, we're sitting here and the long rate's at 3.2% and the short rate's at 2.5%, okay? A lot of interest rate movement upward, okay? Is that a disaster? No, that's 2019. That's 2019. Those interest rates I just described were 2019. If we'd have had this conversation in 2019, you would have said, how much longer can these low interest rates last? Right?
Yeah.
You wouldn't be referring to them as high. I'm sure you had that conversation with people, right? So to understand that even a big interest rate movement back is simply to 2019, which, by the way, most real estate people said, thank you very much. This is pretty cheap money, because it is.
Yep.
We then had a fire sale where the government gave money away if you were willing to borrow. And the biggest borrower, of course, was the US government. The biggest borrower in the world during that was the US government. They subsidized US government and they subsidized borrowers. Well, if they stop subsidizing borrowers, that hurts borrowers and helps lenders. It helps savers and hurts debtors. But it's not like one's more noble than the other. A dollar gained by one or lost by the other washes primarily. So I don't get hung up on that. Balance sheets are pretty sane. And so you just have to have a bit of context. And by the way, telling the US government that their money isn't free is not the worst thing we could do, because they're like little children if candy's free. If little children are given candy for free, right? And you say, whoa, you got to slow down. You got to buy that, right? Slows them down. That's Congress. If you give them, or the system, if you give it free money, guess what? They use it like it's free.
Yeah. So when it comes to like, speaking of washes, when it comes to the other asset classes that we deal with in commercial real estate, retail, industrial, multi-res, office space, what we had in our office, which was not dissimilar, I think now we're at 85 locations, 85 major markets. And what we had in our headquarters was during COVID, we almost revenue was down, top line was down, but it was close. And what happened was we had industrial and multi-res really were the darlings of the industry. And they kind of made up for retail, or like you said, not, grocery store anchored or really good retail. And on the other side, the office. So office and retail was the drag. Those other two asset classes came up and, picked up the slack. Do you see this trend continuing? What are your thoughts on the various asset classes moving forward?
Okay, real quick. Multifamily, in December 2020, I wrote a piece, we're entering the golden era of multifamily investing. And it was because spreads were big, capital was available to borrow, debt was being given away because of the subsidy. Rent and occupancy are good and going to get a lot better. Well, that happened. in the last 15 months. It still has legs, but some of the gold has already been harvested. All right. So it's not like we're in a bad period for multifamily, but we're in a golden period, but a lot of the gold has already been harvested. Rent and occupancy look good going forward. Demographics look good. Fundamental undersupply of housing, multi, especially single. And so it has good fundamentals. It can be overbuilt, but then you go to industrial. Industrial took me a while to figure out. I think I finally figured it out. Normally, you would think if GDP, I'm using it as a crude measure of demand, if it grew by 2.5%, we'd need about 2.5% more warehouse, because 2.5% more GDP, 2.5% more boxes, right? Just kind of crudely. And that had kind of been a good rule of thumb. We always did more precisely, but as a rule of thumb. And then what happened is we'd see 2.5% of growth of GDP and 4% growth in warehouse and you'd demand. And you say, well, that's odd, can't last. And then the next year you'd see the same thing, 2016. Then the next thing in 17, next thing in 18, 19, you kept seeing it. I finally figured out that if you buy that shirt in a store, it takes 1/3 of the warehouse space that if you buy it online. Because an online facility has wider aisles, more staging areas, small box handling rather than big box handling, a lot more loading in and out needed, a lot more moving around than let's move a box here or there, let's move a pallet. So online sales use about 3 times the amount of space. Well, that means, and this 2.5 generates 4 is about the right math. And given the growth of online, that's going to continue for a number of years. So when does the rent and occupancy balance? When we start building 4.5%, and demand grows at 4.5%. Well, that's not going to happen for another couple of years. So the rent and occupancy fundamentals there look pretty good, even as we build more and more. The real risk there, there are 2. One, a lot of online sales don't make money. And a lot of retailers realized that during the pandemic. So are they still going to be so aggressive selling online? And if not, it gets it closer to the 2.5 generates 2.5. And the other is every morning somebody wakes up, a whole bunch of people wake up at Amazon saying, how do we get it from 3 times the amount of footage needed for an online sale to 2 times? And if they do that, it changes the math. You then go to retail. I've never wanted to own bad retail. I've always wanted to own good retail. If you own good retail, you're constantly having to reinvent it through its entire history. But if it's a great location and you have a core of good retailers, it's a dynamic business. It's a hard, grinded out business. I love the dynamics of great retail. And in fact, online sales have been flat for the last year, high but flat, while brick retail is getting record sales. And as online gets back to trend, then the trend will continue. But I like good retail. Why would I like bad retail? I mean, it just, and I remember Al Taubman, long time, kind of one of the gods of the industry, certainly one of the gods of retail, I don't know, 30 years ago, 35 years ago, said, you can't buy bad retail cheaply enough to make it work. Yeah. And that's because even if you get it for almost nothing, your rent cannot be cut low enough to change the price of Cheerios. And if you can't change the price of Cheerios, people aren't going to shop there. And if they're not going to shop there, you don't have good retail, right? So good retail, I like the outlook for. Hotels making a comeback, weakest part is if you're highly dependent on Chinese tourists, kind of 2-star, 3-star Chinese tourists, they're not coming back for another couple of years. And if that was your sweet zone, was playing to them, that's going to be the slowest recovery. But it looks like this summer, pending another surge, absent another surge, going to be a great summer and into the fall. And what did I miss?
So before we get to office, I just had a question. A question on retail. Whether it's North America in general, whether it's American or a Canadian, I think it's 32, 33 square foot of retail per capita. I think something like that. We're not much better in Canada than the US. Obviously, the European countries have not built as much. Do you see that there's this conversation, or has been over the last 2 years, that a lot of these potentially multifamily or retail lower tier areas are going to be redeveloped, repurposed, whether it's industrial or whether it's multi-res? Is that something you do see, developers actually looking at that? Yeah.
And by the way, it's been happening for 20 years. It's the pandemic probably sped it up because it pushed so many retailers that were going to go out of business. The thing that kept them from shutting, I mean, we looked at doing some of those deals. The problem is you have one tenant paying $2 a foot. So even though they're only selling $114, they actually make profit in the store at $2 a foot rent. And that's because the lease was signed 30 years ago with options, right? I'm being extreme, but you get the point.
Yeah.
And nobody else wants to be there, but I can't buy it, shut it down, and build apartments, or I can't do anything with it. That happens over time. That will happen over time. So absolutely. And the notion that we have too much retail reminds me, remember, you're old enough, remember how you would drive by the old industrial areas of America, and you just see these empty warehouses, these empty 1920s, 1910s, 1940s buildings.
Yeah.
That were counted as empty industrial, but they weren't empty industrial. They were just empty space.
Yeah.
And if you wanted to call them industrial, but it's not really. If you got rid of the space in retail, that's irrelevant. It was once retail, but it's irrelevant. Just like that old factory that shut in 1972 was irrelevant as industrial space. The amount of footage we have goes way down. Now, that's not to say it gets to the right amount, but it goes way down in the same way the old industrial did.
Yeah, it's like a decommissioned asset class. But so the reason I wanted to say,
that's what we ought to have. We ought to have, if people did it really carefully, they'd create a new class, obsolete real estate of any type, right? And then you'd see the retail stock go down. You'd see the industrial stock go down. Although the industrial has kind of run its course, those old buildings have been dealt with over the last 20 years.
So the wild card, office space. We track all the major markets. We have seen pretty much every US market has come back from cell phone data that we have into the major cities. We are a little bit slower just because our government policies have been, they are what they are. We'll not get into a political thing here. But what we have seen is a lot of these markets, a huge increase in the percentage of the office market being sublease space. Now we're starting to see that trend go the other way, starting to come back down. And what we've seen in the markets that we are in here is that really good positioned office space in major cities continue, and it looks like the outlook is positive. Potentially not the same for the suburban area. What are your thoughts on the office, just philosophically first, and then maybe some of the data that you're seeing?
So I totally agree with your view. I think people have people fell in love with this fantasy that I don't have to be at work. I don't have to be answerable. I'm self-motivated. To work at home, if you're really honest, you have to be pretty highly self-motivated, pretty disciplined, have a good work environment, and be able to control your schedule pretty effectively. Well, there are people like that. Those are the people who are already working at home. Those are the people who are working from the airport. Those were the people who were working while they were on the road, et cetera. Having said that, I'm always amazed that when I fly back from Europe, which I do quite a bit, and I'm in business class. So these are, quote, a lot of worker types. And when you're flying from Europe to the United States, it's a work day, right? It's not night. It's not like when you go the other direction and it's night. Look around and see what people, these business people, these hardworking, disciplined people are doing as they fly from Europe to the United States. About a third sleep, and all but about 10% of the others do nothing, read a book, or watch movies. Well, this is a work day, for God's sake. So I'm sitting there working away, and I realize most people don't have that discipline. I'm not saying I'm great. I'm just saying they don't have that discipline. The other variant of that I like to point out to people is, I think Ricky Gervais is a brilliant writer, comedian, and he created The Office. He created many things. He created The Office, both the British and US version. And it was built around the notion that it's really hard to get people to work while they're at the office. If you think it's really hard working while you got them at the office, what do you think Ricky Gervais's show Working from Home would look like? I mean,
Yeah.
Let's be honest, right?
Yeah.
And people will go back. Now, I'll give you the last reason I think people go back, and it's self-preservation. There's tipping points here. And if nobody's at the office, what's the point of me going to the office, right? I mean, if all I'm going to do is go to the office and sit alone and not interact and be around people, there's no advantage. Then as a whole lot of people get there, there's advantages. And then as more than the majority are there, I got to be there, because otherwise I don't know what they're saying about me. And I don't know who's getting the plum assignments. Yep. So it can flip from, if nobody's there, there's absolutely no reason to go there. But if basically everybody, when I say everybody, I mean everybody a la 2019. If basically everybody's there, like it or not, I got to be there to protect myself. And self-defense is an amazing instinct of our species. And that's what ultimately is going to bring us back.
I had a number of people early in the pandemic. They knew I worked in commercial real estate. We specialized for the most part in an office. And they were like, what are your thoughts on the pandemic? It turns out, the Zoom calls, all this, we can work from home. And my response was always, if you're in my industry and you don't know that this was a secular trend that was happening long before COVID, this idea of agile offices, working for, and we needed kind of a kick in the butt to get the technology where we needed. I don't think you've been kind of paying attention to the market. I think my outlook is that it's a general positive thing, but I'm the perfect candidate as a commercial broker that I should be able to work at home all day, no problem. And I can, but like you said, as motivated as I am, being around my team, being accountable to them, physically seeing them, being in the space, having just a different idea of my TV's over here, versus, and my couch is over here, versus I'm in the office and I'm in a different mode. That it seemed like an insignificant thing at the beginning of COVID. I've come to realize it's a crucial part of how I work.
Huge. And one of the things I say to people, I'm old, I'm 71. One of the things I say to people is, I'm not sure that this Zoom wouldn't be better if you couldn't see me, because I'm not that good looking. Okay. And that's called a conference call. Now, yes, it wasn't encrypted. And yes, so I'm not trying to say technology hasn't made it better. It's easier for you to get a lot of viewers all in at once and so forth and so on versus a conference call. But we were doing, from 2011 to 2019, we were doing quarterly economic updates for our subscribers that would have like 500 people on, old-fashioned phone hookup. We didn't have big problems. And I didn't get a lot of people saying, oh, I'm going to commit suicide because I didn't see your lovely face. Yeah. And let's be honest, you're a good looking guy. I'm not. There are a few people worth looking at, but most of us, it doesn't add to the conversation.
Yeah, I'll be happy if I look like that at 71, Peter. So don't sell yourself short. We've got about 10 minutes left here. I want to be a little mindful of your time, but before we wrap up, maybe you could kind of provide a little bit of insights, crystal ball for us, what you think the future holds for the commercial real estate industry. And maybe you could kind of couch that with this idea of, people talking about the potential next recession, interest rates going up, political unrest. What are your thoughts?
okay, if we don't have a huge reoccurrence of some very bad version of COVID, right? Because we shut down to varying degrees, okay? If we don't have NATO somehow dragged into the Ukrainian situation, which could be very violent and really escalate, and we don't have a political reaction like we did in 1971 when Nixon introduced wage and price controls, the US economy is going to do terrific for the next 4, 5, 6, 7 years. Most of the excesses that existed, I'm not saying all, most got washed out of the system in 2020, 2021. It was kind of a reset, kind of a reboot. We got a new base zero. And I think we get 5, 6, 7 years of runway, unless we do something, we as a species do something that really is harmful, and COVID would fit that. The NATO being dragged in militarily, and wage and price controls. I saw wage and price controls when I was just out of college destroy an economy. I mean, overnight destroy an economy. And it would do it, it would do it again. That's the biggest risk I see to the economy, because I think that's more possible than the COVID being huge or the NATO, but they're all possible. Short of that, the economy is going to do just fine. And I'll give you my reaction. I've only started saying this, I don't know if I said it on Hunters, which is, I had true story. By the way, I'll tell you when I'm lying. True story is, I had lunch with a friend about 3, 4 weeks ago. And he said, you know, Peter, I follow you and you're smart and all this stuff, great and wonderful, but interest rates going to go up, and inflation, and the divided Congress, and Ukraine. And by the way, he went on to name like 6 things, each of them very real. It's not like he's out of touch. Each of them is a very real challenge. Our education system is shambles, and so forth. And he said, therefore, I don't see the US economy has a future. I don't see how we come back from this one. I just don't see how we grow from here. And I said, Bob, his name's Bob. I said, Bob, anytime in my life, any intelligent person could have laid out 6 to 7 big challenges that existed at that moment. And the next word shouldn't be therefore. It should be, and yet we grew. And I'll come back to what we just went through. Imagine in 2019, we had this conversation and we were completely prescient. And you would have said, Peter, we're going to have COVID. We're going to have a shutdown of a third of the economy. We're going to have riots in our cities. We're going to have Congress can't get along. We're going to have a highly contentious election. They're going to be in the Capitol building. What have I missed, right? Inflation, oil prices at 100 and whatever a barrel. Excuse me. And you would have said, therefore, in 2019, if you were completely prescient, you'd have said, therefore, we can't grow. I'd come back to you and say, Jesse, we grew 3.5% in spite of. Imagine what we do when we only have a short list of those things. So I think if I had one message, that's it. And therefore, if you're in the real estate business, you're in the business of satisfying that growth, right? That's what our business is. When you come down to it, you're in the business. And so, could there be a bad period? Yeah, there's been bad periods. The amazing thing is how short they are and how shallow they are. They don't seem short while they're going on. It's like when you have the flu or COVID. It doesn't seem like short when you got it. But when you look back, it's a blip. And it doesn't seem that minor. But when it's done, I had 2 hip replacements, and it was not fun as you're doing it. But, in the big scheme of life, there was nothing particular.
Yeah. Yeah,
Same with the economy and
I
its
like that.
stats.
In spite of, not therefore. And the reason I'm laughing is because I remember two and a half years ago being in an office and we were talking. It was right at the pinnacle of co-working and WeWork, and we just said to the other brokers, we were like, I don't understand how they can continue to do this. And we said, well, barring any geopolitical event or global pandemic, I swear to God, somebody said this in the meeting. Then, we'll see what happens. And then what happens a year later. And it turns out that, WeWork's a little bit of a different story, but the office market looks like it's coming back. Co-working looks like it's going through a shift, but I really like that in spite of, that is a glass half full.
If I had one message,
Yeah,
that would be it. If I had one message, I'd hope everybody would take one message. It's not therefore, it's in spite of. And by the way, think about I was alive when wage and price controls are going on. Nixon resigns in disgrace. This is the person who had been the Speaker of the House a couple of years prior to that is suddenly the president. And by the way, we had just finished Vietnam and inflation is high and taxes are high. And we grew.
Yeah.
Over, and you kind of, holy cow, this is a powerful machine. It's an in spite of machine, not a therefore machine. Now, obviously, if you get a Venezuela, right, that's when it becomes a therefore. We aren't a Venezuela.
Yeah. Well, hopefully we're not tracking the Bolivar here in Canada or the US. But Peter, exactly. In terms of, so I want to wrap up. I want to give listeners a way to reach out, or if anybody wants to connect online. Before we do, we typically ask our guests a couple questions. I'm going to make these brief, so if you're okay, I'll send these off to you. They're pretty straightforward.
Okay, great.
For younger individuals getting into our industry, what advice would you give to them? Read, and then whatever you do, read more, and then whatever you do, read. And the only thing I'd footnote read to include real podcasts like yours, all right? Yep. Real thought podcasts, not just political rant podcasts, right? Real podcasts. I try to start every morning while I'm doing a little exercise, listening to a podcast outside of my expertise. And so I would include serious podcasts in the read category. You just want to attain knowledge. You want to attain judgment through others. You want to hear what people they may not be smarter than you, but they've got a different set of experiences. They've got a different set of expertise. They're not necessarily right. Get as much of that as you can and start building your own tapestry of knowledge and insight. So which is all these little, that's why I really mean all these little threads coming together. So the second ties into the first. What's a book? I mean, you are the author in our industry. What's a book you would recommend for anybody in our industry or outside in general? Well, I mean, it's self-serving. That to a young person, it is self-serving, but I would say my book, Real Estate, Finance, and Investments. If you were to say, this is also self-serving, but I also believe it, there are going to be dramatic changes in how long people live. So Albert Ratner and Mike Roizen and I have a book coming out in September called The Great Age Reboot, and it's going to change. It's going to change. I'd love to come back as it comes out and talk to you with Dr. Mike. But when it comes out, it will give you insights on what's going on in modern medicine and what it means for our society. And I give you just a snippet, right? A very tiny little snippet. Imagine genetic engineering could eliminate fat, excess fat, okay? First of all, medical expenditures would go way down, healthcare expenditures. We'd have some number like $2 to $3 trillion more to spend on other stuff. What do you want to spend it on? Not to mention that, and I'm just being simple on that one, and there's hundreds of them. On that one, I'd want to short Weight Watchers and go long in Haagen-Dazs, because if anything I eat doesn't cause fat because of the genetic engineering, then bring it on, Haagen-Dazs, right? So, I mean, now if you said to me, a great book there's two books that I would recommend that anybody thoughtful and intelligent,
I think should be aware of. One is called Factfulness, Factfulness, by Hans Rosling. He's now deceased. It's about 3 years old, and it's an amazing book that talks about how our images of the world are locked in and not reflective of reality, and the reality is generally much better than we think. And the other, along the similar lines but very different, is The Rational Optimist by Matthew Ridley, and that's probably about 8-9 years old.
Yeah.
But the theme of it is the typical person watching this lives massively better than the Sun King of France, you know, in the 1400s. And you go, wow, you know, I live better than the person who resided in Versailles. And he gives much more cogent examples. The other thing I would do, I was a big Hans Rosling fan. There's an amazing YouTube, about 4 minutes long. And if you put in Hans Rosling, Rosling,
yep.
The World Growth Explained in 4 minutes or something like that. It's a 4-minute video that will leave you feeling good at the end.
Yeah, we'll put a link up to that. I think I've seen this one before. That's great.
Yeah, amazing. So, but those would be the 2 books I would kind of think everybody could read.
That's great. Okay, Peter, we are at the end here. Our last quick question I ask every guest. It's usually more interesting with the older guests. First car, make and model.
Well, wait, first of all, are you asking me? I'm not an old guy. My first personal car or my first family car?
No, your first car that you, that was your baby.
My first personal car was a 1970 American Motors Corporation Green Gremlin.
That is fantastic.
Look it up.
Yeah, I know the car.
It got me from here to there, served me well. But it was a Gremlin, 1970 Green Gremlin.
There's a cottage industry now of guys collecting those cars, the Gremlins.
Yeah, mine fell apart at some point. I got a good, I don't know, 8 years out of it or 7 years out of it, something like that. 7 years, I guess I got out of it. So awesome. It worked.
Awesome. Well, Peter,
what was yours? No, but what was yours? I have to hear yours.
My first car was a Pontiac Sunfire. Back in the day, silver. I was just happy to have 4 wheels and be mobile at 16. And it was all the cars I had when I was younger was stick. I heard an older guy in our office. He said, "What is a manual transmission? It's a security feature, a millennial security feature." Because I don't know if too many people driving stick these days. But that's great. Yeah. Peter, we'll have to have you back on. I really appreciate the conversation today. For any listeners, aside from the website and the Linneman letter, is there any other place that you would kind of point them to online?
That would be the main place. Go to Linneman Associates. You've got links to all the stuff we do there, including our charity, our education charity in Kenya, which is a big part of my wife's and I's life. Take a look at that. It's pretty amazing what these kids do. It's hard. It lifts your spirits and keeps you positive. But just go to Linneman Associates. You'll find us and feel free to get in touch. Thank you.
My guest today has been Peter Linneman. Peter, thanks for being part of Working Capital.
My pleasure.